Throughout the 20th century, the global economy was managed from physical centers of power. Human governors made decisions inside stone buildings, using physical capital to maintain order. This traditional system relied on lagging indicators, like inflation reports and employment data, to adjust interest rates. Control was exerted through the management of physical money stored in massive underground vaults. But that power is relocating. The mechanisms that actually dictate consumer behavior and market liquidity have quietly moved away from government corridors. The new centers of influence are data centers in Northern California. These server farms don't rely on stone facades to project authority. They use real-time data to monitor and influence every financial interaction. Everyday consumer apps serve as the front end for this new architecture. The shift suggests that the primary infrastructure of money is transitioning from physical bank ledgers into the cloud. Physical currency is increasingly becoming a backup system. While stacks of paper money still sit in reserves, the vast majority of daily commerce now takes place through digital interfaces. Mobile wallets like Apple Pay and Google Wallet change the transaction path. The software intercepts the relationship, managing how you spend. As governments develop central bank digital currencies, these nodes bypass banks entirely, plugging directly into the tech platforms you use every day. The goal is to control the point of contact. By managing the interface where the money is spent, tech platforms avoid the regulatory costs of a bank while maintaining full influence over the user. This positioning makes the software layer a mandatory stop for digital commerce. If you own the screen, you own the flow of the transaction. Beneath the screen, the legacy banking infrastructure is struggling. These institutions are often restricted by slow processing systems and regulatory frameworks designed for a pre-digital economy. This gap allowed for a convergence of tech and finance. When Apple partnered with Goldman Sachs to launch a savings account, they combined consumer technology with high-level banking backend. A traditional bank spends years building a capital base, while the Apple-driven account reached billions in days. This shows a shift in value. Brand trust and device loyalty now effectively outweighs the importance of traditional bank capital. Financial regulations are finding it difficult to address this velocity. When a platform can move billions based on consumer loyalty alone, traditional banking rules are no longer the primary constraint. At the deepest level of the stack is the logic board. This is where decisions are made based on the data flowing through the system. The Federal Reserve acts on historical data, looking at what happened in previous months to set future policy. This creates a delay between an economic shift and the government's response. Tech platforms use predictive models to process behavior in real time. This allows them to anticipate economic changes before they are recorded in a government report. By analyzing shifts in search behavior, predictive models identify a likely house purchase months before a mortgage application is filed. Zooming out, a fractional drop in enterprise cloud spending across millions of businesses indicates a cooling economy, long before standard GDP figures. The global economy is being managed by a predictive intelligence that never sleeps. The old indicators are being replaced by real-time behavioral data. These three layers, the front end, the back end, and the AI, form a complete stack. Tech companies have moved beyond simply offering tools. They have integrated themselves into every level of the financial process. In 2026, the primary concern for traditional institutions isn't just a market fluctuation. It is a software update from a tech company that could instantly reroute the flow of capital. For the independent investor, the strategy must change. Success depends on looking past traditional charts and understanding the raw data flow that moves behind them. The center of control has transitioned. Leverage over the economy has shifted from the security of the vault to the speed of the cloud. As the nature of money transforms into a software-driven system, the question is no longer who holds the currency, but who controls the infrastructure that processes it.